Good morning, everybody. It's Greg Harrelson here with Century 21, the Harrelson Group. I'm joined by Abe Safa, also with Century 21, the Harrelson Group, and we just want to, continue the process of updating you on what's going on in the real estate market in the Myrtle Beach, in the Grand Strand area, and just be prepared to just provide you the information to help you make good financial decisions in the area of real estate. So, Abe, thank you again for joining me for another week.
Always a pleasure, Greg. I look forward to these calls.
Yeah, I look forward to just kind of like, talking about the market and getting an update of kind of like where it stands and just sharing our different perspectives. So, if you look at the title here, it says mortgage rates are at 20-year highs. One question that Abe and I are trying to answer ourselves, and we also know that we're getting we're getting the questions from the consumer is, how is this going to impact the real estate market? So Abe, I had mentioned to you this morning after we talked about the 20-year high that I had gotten a message from a mortgage person today that texted me and just informed me that a buyer who's going to get a mortgage, put 20% down and live in the home. So it's their primary residence. That the rate was 7.125 this morning when the rates came out. It went over 7%. And by the way, what I didn't tell you, Abe, is they still had to pay 1 point just to get that rate.
Wow. Okay.
Now, different mortgage companies, you got to understand, will have different rates. This is the one that was texted to me today. There might be somebody a little bit lower. There might be somebody a little bit higher. But what this tells me is this particular person was letting me know their rates just went up, which tells me that everyone probably this morning, probably are issuing higher rates at this moment, wherever they were. So we're talking 7% now. When you say 20-year high, kind of what is your tell us a little bit more about that?
Yeah, I mean I didn't see the 7% this morning. I looked up yesterday's national average, and the national average yesterday was 6.87.
Mm-hmm.
Right, so yeah, it could have gone up some more. I mean, but it fluctuates depending on the credit score, depending on the area as well. So that's significant. Yeah, and that's the highest in over 20 years. Now, what that means, just kind of put that in perspective, what it means to buyers out there, and I think that's why we're seeing such hesitance on buyers right now to move forward on purchasing. Is I went back and I did a mortgage calculation. A $360,000 loan right now, which is what our average price point in this market is right now, at a 3% interest rate, is $1,518 a month payment. At 6.87%, that number goes to $2,364. That's a 56% increase.
Mm-hmm.
So you can see what it does to your buying power. So someone that qualified for a $360,000 home, now all of a sudden can't, right? When it goes up 56% payment, so it's really impacting people. It's impacting affordability. It's impacting people's ability to even want to make a move right now with all that's going on in the economy and the market.
Yeah, whether we like it or not, I'm starting to sense that the government, the feds, or whoever's in charge, well, let's call it the feds, I think would be maybe the most appropriate thing to say around, rates. I think they're going to do everything they can to slow this economy down. At least my opinion on what they're doing. And somebody may be listening to this and say, "Well, obviously, Greg." Well, I think it's becoming obvious that that they're going to do whatever they can to slow it down. And I keep hearing commentators when they talk about they're going to do whatever they can to slow it down. They also say, in order to slow it down, they've got to create pain for people.
Mm-hmm.
They use that. I hear this all the time. Well, there's not enough pain. They got to create more pain. And so I start to hear that, and then I see what's going on, and I'm like, well, this is kind of painful, for people. So whether I agree or disagree is not the point. The point is, it just seems like the intention here is to inflict some sort of pain on the consumer to slow their purchasing down. and it's going to have an impact on real estate. I think one of the things that we've seen, you had mentioned that the medium price, because people are saying, hey, look, how are the prices coming down? For the most part, we've been saying, no, they've been held steady. But I think we're just now starting to see that the median price is starting to adjust. Have we seen that?
Yeah. So for the longest time, we were concerned about inventory, right? For a little while, inventory spiked, and then we saw the inventory level off the last 2.5 months, right? So we're like, okay, maybe that's a good sign. Okay, but then we started seeing more and more price reductions. So right now we're seeing as many price reductions as we would see in a buyer's market, even though inventory is showing that it's still a seller's market based on the total number of homes on the market for sale. We're seeing as many price reductions as it would be a buyer's market. So now we're starting to see prices come down. So if you look at the median sales price in our area, back in June and July, it was the same exact number. It was $375,000. By the end of August, that number turned to $360,000. Right, not a significant change. If you compare it to last year, it's still up significantly. Right, compared to 2019, it's way up. Right, but we're starting to see the impact of what these high interest rates are doing. They're starting to choke the real estate market. And you're right. There's no question about it. There's going to be pain, but what we don't know is how significant of an impact are we going to have in the housing market with the government trying to reduce inflation. Right, their job, plain and simple, they want to reduce inflation, but at what cost to the real estate market, we just don't know. That's how bad it's going to get.
Yeah. So what you're talking about is a trend, right? You just basically shared a 3-month trend. And so like, I'm going to go back, and we won't need to be extremely accurate on these numbers, but do you remember when there was a trend 3 months in a row where the prices were going up and the prices were going up and the prices were going up? Every seller assumed that because the prices went up, then up, then up, they assumed the 4th month it was going to go up, right? And they started raising their prices. Now, what's interesting is when the markets goes up, 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 sellers are quick to assume and quick to react. Oh, there's a trend. I'm going to raise my price. But when the market goes down, and it goes down, 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 sellers are slow to react and adjust their price. Buyers are fast to react. When it goes down, 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 they assume the 4th month it's going to go down, and they're fast to react at making lower offers. When the market's going up, 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 sellers assume 4th month it's going to go up. Sellers are fast to raise their price. Buyers are slow to meet their price. When it's going down, sellers are slow to adjust their price, and buyers are fast to actually make a decision to offer less. And that's kind of interesting. We're seeing offers still coming in, but we're seeing, like 6 months ago, the number of offers that I got was much higher, and the chances and the chances that one of those offers work out for the seller was very high. Now we're getting offers, but the offers are coming in lower, and the sellers are kind of holding firm, and now the properties are starting to sit. Now, we don't have a crystal ball, right? We don't know what prices are going to be doing in the future, but we do know that the average list price to sales price, the percentage of price, we know that was down, down, down. We do know that. What's going to happen in the 4th month? Maybe it turns back up. I don't know, and I'm surely not going to actually, pretend that I do.
Yeah, we can't make that prediction, Greg, but I can't imagine that it would go back up. Right, we're seeing a lot more withdrawals come off the market right now. We're starting to see expireds come off the market again, which we haven't seen in a couple of years. Like you said, the average sales price to list price is down 3 months in a row. Interest rates are going up. 3-4 months ago, if you would have said 7% interest rate, I wouldn't think we were going to get there. Now we broke 7. Now people are talking possibly 8.
Yeah.
So yeah, it's not looking too bright out there. And the Fed still has 2 more meetings, and they're saying probably at least another full point increase between the 2 meetings.
Yeah. Wow. Yeah, I believe it. Again, I'm just my gut. I mean, I really don't have any data to show what they're, why I believe they're going to do a certain thing, but my gut tells me that they are. We had a buyer say to us this last week. I was talking with one of my agents, and one of the agents in the office, and she said that she was talking to her buyer, and the buyer said to her, every property that's currently listed is overpriced. That's what the buyer said right before they made an offer of $470,000 on a property that was listed at $499,900. So they made an offer of $30,000 less, when before that offer would have probably been full price, or at least $490,000, $495,000. So those are the things that we deal with, in the field that we're trying to navigate through, and just want to kind of communicate the type of conversations that the consumer's having for those that are listening. What about, I know we talked about mortgages, like just because a lot of people have a hard time, even myself have a hard time, like understanding, okay, interest rates are up, but what does that really mean? In the respects to if they're trying to inflict more pain on the consumer, to slow them down. Can you describe, do you know how the interest rates actually impact? How does that correlate to pain when it comes to payments?
Well, it's taking buyers out of the market. So, I mean, there are many buyers that would have qualified at a 3% interest rate, 3.5, even 4% interest rate, and now it's up to 7%. All of a sudden, if their payment increased 30 or 40 or 50, 56%, like what's happened between 3% and 6.87, that makes it unaffordable for people. So that takes a certain percentage of the buyers out of the market. My guess, my estimate is somewhere around between now and, let's just say 4 months ago, I'm willing to bet we lost 40% of our buyer pool in the overall market. So that's buyers that wanted to buy a home, probably still want to buy a home, but either can't afford to buy a home right now, or are choosing to kind of wait and ride things out a little bit, thinking that things are going to get better. So when you take away 40% of the buyer pool out there, okay, that makes it tough for sellers out there.
Yeah.
Okay,
go ahead, please.
I was gonna say, then the flip side of it, if you got homeowners that aren't bringing new inventory to the market, just like you said, that one buyer is saying, look, every single home out there is overpriced. Okay, well, sellers right now, if they just refinance, which we had the biggest refinancing boom we've ever had when interest rates were low. So everybody just about refinanced. So now you've got sellers that are locked in at 2.9, 3%. For them to turn around and sell their home, buy a new home at 7%, you can see what it does to their payment if they bought the same exact price home. So what's happening, that's not bringing in as much new properties to the market. It's not exciting buyers. It's kind of like, it's just muddy waters right now. It's just kind of
well,
bland.
I think that you calculated that a $360,000 loan at 3%, which somebody could have got, a year ago, at 3% would have been around $1,518, $1,518 as a mortgage payment. And right now, even if we just say, well, the interest rate is 6.87%, we don't even say 7%, that same $1,500 payment is now on the same property, same price, same loan, would be $2,364. So the payment went from $1,518 to $2,364. That right there, there's a lot of people that there's more people that could have afforded $1,500 that then could afford $2,300.
Yeah.
I wonder, Abe, maybe for next week, if you can think of this would have been interesting. I wonder, like, okay, you're using $360,000 as the loan amount, but I wonder, like, that's how much their payment went up. How much did their buying power go down? Because if the person could have afforded a $360,000 loan because it's $1,500, but now because it's $2,364, now what will $1,500 buy them now? In other words, $1,500 a month loan won't buy them the same house. They would probably have to go from a $380,000 house to a $280,000 house. So it's not that their payments went up, because people can't just have more payments. They have to actually downgrade what they're buying to keep their payments within their budget. So their buying power significantly decreased.
Yeah, we could run the numbers backward, but yeah, that's significant, because I mean, you're talking about the payment went up 56%.
56%.
That really brings down their buying power.
Yeah.
It brings it down, and if that was, because that's the average price point, if it brings it down that much, there's no homes out there in that price range anymore.
That's right.
Right.
So the question becomes, not that we have the exact answer, but how will it impact the Myrtle Beach real estate market? The key is that there's always going to be real estate transactions. So if the buyers are slowing down their purchasing, eventually some sellers will need to sell, so they'll have to adjust their pricing to meet the buyer's demand. Now, we don't know it. Now, if this turns around, then, in 2 months from now, interest rates start coming down. I don't believe it will, but let's just say hypothetically, if they did, then there might not be much impact. But if this stretches out for 6 months or a year, there's going to be an impact, because some sellers will have circumstances that require that they sell soon. And they'll adjust their price. They'll set new comps. It'll affect the appraisal values. And then, that kind of starts to spiral. Now, I will say, crash, still not saying that there's going to be a crash. But we do know that it would be foolish if we didn't say that the market is softening. It would be absolutely reckless for us to not state that to our audience at this time.
No question about that. Some people are starting to talk crash. I don't see it.
Yeah.
Unless we start seeing inventory really start to rise again. If inventory stays the way it is, it's not. I don't think it's possible to have a crash. Yeah. So we'd have to see a significant increase in inventory for that to happen. Now, I do want to say one thing out there, because you mentioned something that's very accurate. There's always going to be transactions in the market. There's always going to be sellers. There's always going to be buyers, because people have to move. Things happen in life, right? So just want to give a little bit of advice to some sellers out there if they're thinking of selling. Like, you've got to be really careful right now to look at the numbers, look at the market when you price your home. Okay, you can't just look at the last 6 months and look at what the average sales price is and price it to what it was in the past. It's going to be really difficult and frustrating for you right now if you're trying to go based on the last 6 months prices. Now, having said that, I'm not saying that you should reduce the price just haphazardly, right? You got to really pay attention to the numbers, pay attention to the competition that's out there for your type of home, for your price point, for your community. Take a look at those. And then secondly, like, you have to make sure your expectations are realistic. Okay. For the longest time, for 2 years now, homes were selling in a day, 2 days. The average home on the market was like 10, 14 days. Those days are gone. If you go back to 2019 and previous, the average days on the market in this market were 141 days. Right. I'm seeing sellers hit the market right now and withdraw after 12, 13, 14 days.
Yes.
Okay. That tells me they went in with false expectations. So really, really make sure that you have a solid conversation with your real estate agent, and make sure you get a clear picture of what you're getting into and have a plan.
Yeah. One other thing, and we apologize for going a little bit longer today, but I just think that was an important point, and I want to just kind of add on to that. And that is, I want everyone to understand that, like, right now, the strategy to get a higher price is to be a little bit more aggressive on your list price and hold firm on the negotiation. Mm-hmm. So instead of pricing it at $230, knowing you'll take $220, and then it sits on the market, consider pricing it at $225, but still holding firm at your $220. There's a big difference in the pricing strategy and the ending price that you accept. In a hot market, the strategy to get you the most money is to price in a huge cushion, because we knew we were going to get it sold. We knew it was going to get offers. And a lot of times, we didn't want to leave any money on the table. So we really priced it high, thinking we will end up high. And we did. That was a hot market. Now what you do, we're not going to try to price it low, but we have to have real conversations on what you're really trying to accomplish on your pricing. And then your pricing strategy should be a little bit more firm in your asking price, so we can get you the same price that you want. The challenge is some people will still use last year's pricing strategy, which then will give the perception that they're extremely overpriced. They'll never get any showings. The market will sit, and then it requires a drastic price reduction. And once you go down that path, now all of a sudden you will end up having to take less. So I think, Abe, when you're talking about, make sure you have good conversations with your sellers or your agent. It's important. The days of choosing an agent just because of a friendly relationship, those days are over. You have to choose a professional that has experience in this type of market, knows the data, knows what strategies are working right now to protect your equity. So please, just if we can do anything for you, Abe and I are always interested in earning your business. One thing hopefully you understand, we will be very transparent, share with you our opinions, give you our guidance, and help you reach your goals at the best of our abilities. Abe, thank you again. And there's our contact information right at the bottom. If you all need anything, please reach out to us. Abe, thank you so much.
Thank you all for watching.
All right, bye.